World stocks just got hammered by a semiconductor rout, an event that sent shockwaves through global markets. But while retail investors focused on the immediate dip, institutional capital is watching something far more critical: a structural repricing of foundational technology and a persistent geopolitical premium now baked into essential energy. The real story isn't just about a headline decline, it's about the underlying shifts dictating where capital flows next. Let's first dissect the semiconductor sector. Its core moat isn't just in manufacturing, it's in intellectual property, design, and the immense capital required for leading-edge fabrication. Companies like NVIDIA, TSMC, and ASML command segments from design to advanced lithography, making them irreplaceable. Their value proposition is enabling virtually every modern industry, from AI to automotive, creating a deep, interconnected ecosystem. Now, consider the energy sector, specifically oil. Its moat lies in resource access, vast infrastructure for extraction and refining, and the inherent inelasticity of global demand. Major players like ExxonMobil and Chevron operate integrated models from upstream exploration to downstream distribution. Their value proposition is powering the global economy, making them foundational, albeit increasingly scrutinized, components of industrial output and everyday life. The recent semiconductor rout, while sharp, often masks cyclical dynamics within a strong structural uptrend. We are seeing some inventory adjustments in specific segments, alongside a recalibration of demand projections in others. However, areas tied to AI acceleration, like data center and high-performance computing, continue to show robust demand. The street is wrestling with whether this is a temporary hiccup or a more significant slowdown in broader chip demand. Meanwhile, crude oil's recent price surge directly reflects geopolitical tensions escalating in the Middle East. This isn't just about immediate supply disruptions, it's about a risk premium being re-embedded into the commodity. Refining margins are also reacting to this volatility, creating uneven profitability across the integrated energy value chain. The market is now pricing in a higher baseline for energy costs, impacting inflation expectations globally. Across the semiconductor industry, management commentary points to continued strategic investment in next-generation technologies. Despite some near-term softness, leaders like NVIDIA and TSMC emphasize robust long-term demand drivers for AI, infrastructure, and advanced computing. Capital allocation remains heavily geared towards research and development, alongside expansion of capacity to meet anticipated future growth. This suggests conviction beyond current market jitters. In the energy sector, CEOs are navigating a complex landscape of energy transition mandates and persistent fossil fuel demand. Commentary from companies like ExxonMobil and Chevron highlights a dual strategy: optimizing existing assets for maximum efficiency and cash flow, while selectively investing in lower carbon solutions. Shareholder returns via dividends and buybacks remain a priority, signaling a disciplined approach to capital deployment amidst volatility. The macro environment for semiconductors is fascinating. We have a robust AI boom driving insatiable demand for high-performance chips, yet global economic growth is showing signs of cooling. Geopolitical tensions, particularly between the US and China, remain a major structural factor, shaping supply chain resilience and technology export controls. This creates a bifurcated market: hypergrowth in AI, coexisting with broader cyclical pressures. For oil, the industry context is dominated by a delicate balance. OPEC, production decisions, EV, adoption rates, and global economic activity are all critical variables. The ongoing Middle East escalation adds an unpredictable layer, tightening supply expectations at a time of relatively constrained spare capacity. This dynamic fuels inflation concerns and influences central bank policy, making energy a pivotal macro variable. The semiconductor sector faces acute risks. Geopolitical instability, particularly regarding Taiwan, poses an existential threat to global chip supply. Regulatory pressures from various governments, aiming to control advanced technology, could fragment markets and increase operational costs. Furthermore, the inherent cyclicality of demand, amplified by inventory corrections, creates periods of significant volatility. Margin compression can occur if pricing power erodes, despite strong structural tailwinds. For oil, the risks are equally complex. Renewed geopolitical tensions could trigger supply shocks, sending prices soaring and potentially sparking global recessions. On the other hand, a sudden de-escalation or demand destruction from a severe economic downturn could see prices collapse. Long-term, evolving environmental regulations and the accelerating energy transition pose a structural threat to demand, creating a tension between short-term supply scarcity and long-term demand uncertainty. Looking ahead, the semiconductor sector's multi-year thesis remains anchored in the exponential growth of AI, high-performance computing, and electrification. While near-term corrections are painful, they can present opportunities for valuation reassessment. We anticipate continued strong earnings visibility from leaders in critical segments like AI, accelerators, and advanced logic. The structural momentum supporting this sector is intact, but the pathway will remain volatile. For oil, the forward outlook suggests a continuation of the geopolitical risk premium. Supply-demand dynamics will be heavily influenced by OPEC actions and any further escalation in the Middle East. This implies ongoing yield pressure and potential for higher energy costs to fuel inflation, keeping central banks on edge. While the long-term energy transition narrative persists, the immediate reality points to sustained demand for fossil fuels, supporting current valuations for integrated majors. Considering these dynamics, we view the current semiconductor rout as a potential breakout watch opportunity for long-term investors in foundational AI, and advanced logic plays like NVIDIA and ASML, after this consolidation. The underlying structural demand remains strong. Conversely, for traditional energy, while the geopolitical premium offers near-term support, the long-term structural shift warrants trim consideration on major valuation extensions, particularly as the energy transition narrative matures. This market repricing is more than just daily noise, it's a critical signal for capital allocation in the coming quarters. Understanding these structural shifts, from the deep moats in advanced computing to the complex interplay of geopolitics and energy demand, is how institutional investors navigate true market cycles. Stay ahead of these powerful trends. For more institutional-grade analysis and structural investment insights, subscribe to SR Money News. We are constantly analyzing the signals that matter most to your portfolio.